Always good to see you. So wrapping up a big week. Let's start with the big tech earnings, because you saw the reports, Simeon, you were listening to those calls. Tech has been leading this market. Would you expect that to continue?
Look, the earnings were very well received, all but one. Everybody knows Meta was the one that wasn't well received. Let's just look at the season so far. We're about 2/3 of the way through earnings season. S&P 500 earnings up year over year about 10%. Tech sector up about 20%. Now, I don't think there's anywhere else we can look to get the equity market rally to sustain, but that's pretty good. That should be enough to keep things going, particularly at this time of year, because we know what folks do towards the end of the year. They want to get those Mag 7 names in the portfolio, in those statements. So when clients and asset managers look them up, they say, oh yeah, that was in there.
Let me ask you, if tech did cool, Simeon, do you look around and say, okay, there's certain sectors that would be well positioned to play catch up?
Look, almost everything else is positioned for catch-up. The funny thing that I find these days is that folks will look to other parts of the market and say it's at a discount to the S&P 500. Well, that's tautological, because the tech sector is so expensive that it's pushed up valuations for the S&P 500. So everything on a relative basis looks like it's cheap. So it's good to look a little bit past that to see what's actually cheap relative to its own history. But there are clearly opportunities. Certainly, we like some of the cyclical places where the value sectors and really quality value, like dividend growth stocks that have been left far behind, but there's almost anything that's been left behind in this rally is open to participation, very importantly because quality overall is pretty good. Net debt to EBITDA for the S&P 500 is at 1.5 times. That is all-time low. So we can talk about cockroaches and private credit, but the quality of all the large cap stocks, including the 493, is pretty high. So the opportunity for rotation across the board is a decent one.
I want to switch gears, talk about the Fed, because we got that this week too. Now you got your cut, but then Jay Powell talking about the December cut says, hey, no sure thing. Far from it, I think is what he said. You were listening to that. What did you make of that as an investor?
We like the logic that I call 2-3-4. What is 2-3-4? If we get to inflation of 2%, then Fed funds should be 3, and the 10-year Treasury should be 4. So we can call this the last of the easy Fed cuts, because inflation's not at 2, it's at 3. So therefore, Fed funds in a neutral spot would be 4 right now. Hence, this is the last of the easy cuts. And I think that's a lot of what Chair Powell said. The next one's not going to be easy. We're going to have to start to make some progress to 2% to cut meaningfully further, and that's important. But the other takeaway of 2-3-4 is what's already at 4. The 10-year is already at 4. No surprise that it sold off just a little bit. You had 25 bips off Fed funds, and the 10-year yield went up 10 basis points this week, because we're not all the way down to 2% inflation.
Well, let me ask you, if you were spinning ahead in December, and let's say you did get a pause, I'm curious how you think the stock market would react to that.
So I don't think that that's much of a headwind for the equity markets, nor would I suggest that a cut is much of a tailwind, because the long end is likely to be stable. Multiples for at least large cap stocks are more driven by the longer end of the curve, which is probably going to be range bound for the logic of 2-3-4. Now, you can still get a little bit of a benefit to small cap stocks in emerging markets, which have more debts at shorter term maturities. So there you can see a little bit sensitivity to whether the Fed cuts or doesn't cut.
What about those, there were folks on this very show, Simeon, who weren't so sure they should be cutting. Their point being, GDP is hanging in there, unemployment's low, the stock market's working, not typically an environment you'd be cutting into.
No, that's exactly right.
Yeah.
In other words, we are probably around neutral right now if inflation is at 3%. And if the risks of the employment market and inflation are roughly balanced, you should stay here until inflation gets down. Now, one of the important things, if you were listening to Powell's comments, was he's actually in the camp that we're closer to 2 than people think. He suggested that their approximation, in the absence of all the data we have, is actually more like 2.8%. And they're still very convinced, we heard this years ago from the post-COVID context, but very much in the context that any tariff impact would be transitory.
I want to get you this. We talked earnings, we talked Fed. we also got to talk trade, because Trump and Xi meet this week. Is the first, face-to-face meeting in a while for those two. It does seem like tensions are at least de-escalating. How, as investors, should I think about that?
Look, it's a darn good thing that it's de-escalating. But if we think about the impacts of tariffs, let's hope that Chair Powell is right, that the impact to inflation is transitory. Let's also hope that the impact to GDP is transitory. You have to go back to your first semester of economics. It's just the supply and demand diagram. If prices go, if a tariff would simply be roughly half borne by consumers and half by producers, because demand is elastic. Demand will go down a little bit, and then prices will go kind of part way down. Simple stuff. But that extra little piece is important. Demand would go down slightly. In other words, there would be a small nick of GDP if tariffs stay high. So, for those of us who are not only generally, free traders, again, nothing's really free, we know in the world there's lots of things going on, but the markets will like lower tariffs, but in higher.
Let's take a look at what we got here. Q4 EPS 185. So the street was at 177. Top line, Q4 revenue 102.47 billion. Street was at 102.19 billion. I'm looking for Greater China revenue, always in focus. That looks like 14.49 billion. The street was closer to 16.43 billion. iPhone revenue, there it is, 49.03 billion. That's up 6% year over year. I don't see a compare yet on that. Looking at others, let's look at Mac revenue, 8.73 billion. Street was at 8.55 billion. Wearables, home and accessories, 9.01 billion versus around 8.6. Services, also in focus always. Higher growth, higher margin, 28.75 billion. She was at 28.18 billion. As always, we would look for guidance on the call. Apple not giving specific formal guidance as we know typically, but they do give greater detail about what's to come for that all-important holiday quarter.
Callie, coming to you out of the box. As always, when you're on here, Apple, did you like that quarter?
For Apple, I did. And what I mean by that is, Apple beat revenue expectations while missing in its two biggest markets, the US and China. That, I think, was surprising to all of Wall Street. Apple has had a little bit of a rough year, especially with the tariff headlines and the fact that a lot of its manufacturing, like many companies, is overseas. But Apple's biggest struggle here is the lack of clarity around its AI plans. That's what the market keeps hitting it on. That and, of course, tariff developments. But tariff developments seem to be heading into the back burner, given all the clarity that we've gotten around that. So Apple's quarter was fine, but I think it's still missing out on that key data point that investors really want.
And as you have quickly become my forward-looking indicator, putting your kid on a potentially driverless car to go to karate, have you gotten a new iPhone? Because I think it may say a lot about how this Apple quarter is going to shape up for the holidays.
I haven't yet, but keep in mind, this is my work iPhone. So I do plan to ask work for a new iPhone because it's been about 4 years, maybe 3, since this one has been upgraded.
Ask them. It's free, Inez. It's free. Ask corporate. Come on.
I know. I always feel bad asking about these things, but yes, I definitely want this new iPhone because it has so many features to it. Look, the fact that their iPhone demand is so strong heading into the holiday season, this has been a real, they've been firing on all cylinders, not just with the iPhones, but also with wearables, with enterprise, Siri making progress, teasing it for next year. There's a reason why the street is bullish on the stock, despite the fact that, it lagged earlier this year because it wasn't part of the AI sort of theme, but nonetheless, they're back to the basics and they are back to the fact that their iPhone is having such strong demand. This lineup is so huge for them.
All right, and as I encourage you to get that free upgrade. Brooke, you know what amazes me this week? I was reading your story on Chipotle. 25 to 34-year-olds, according to CEO Scott Boatwright, not buying big burritos and big bowls from Chipotle, yet they're spending thousands of dollars on new iPhones and various other equipment.
Brian, this is clearly a consumer environment where consumers are extremely choiceful. Even Starbucks CEO Brian Niccol, he said that on his call with investors earlier this week, and they're clearly picking and choosing where exactly they want to spend here. Clearly with this iPhone, which is important to note here, that makes up the most revenue for Apple. Consumers are seeking it out. They're willing to splurge. They're willing to spend, but they're not willing to spend on just about everything. And I've been getting so much feedback from that story that I wrote about Chipotle, young consumers pulling back there, and many people commenting that they're going elsewhere, even maybe a Cava instead. And so it'll be interesting to watch their report out next week.
Callie, back to you. Amazon's quarter getting some high marks because of an accelerated growth rate in AWS. Is AWS just the real driver here? I mean, Amazon has such vast operations. Of course, they have retail operations. They've gotten big into advertising. But that stock is going to probably work if AWS is working right.
Yeah, you're right. Amazon is a behemoth of sorts. It seems like it owns or has its hands in a lot of cookie jars of businesses at the moment. But I think AWS is the key to Amazon's growth story over the next few years. And this goes back to AI. AWS, of course, the cloud services that Amazon has, the growth rate coming out of last quarter was incredibly impressive. We heard some positive comments around that. And what struck me is the fact that a lot of analysts on the street are connecting this to the AI trade flowing through to business results, which is what you want to see when you have these tech companies spending hundreds of $billions on trying to make AI stick to the wall.
Callie, who won the battle of the Mag 7 earnings this week? You know, as we can zoom out, we finally got all these reports. Really, what report really made you sit up and said, wow, you know, that was a good quarter, and you know what, all this AI bullishness, it's definitely justified?
I think it was Amazon, to be honest. I think it was Amazon through that proof point of AWS. I think what struck me more, Brian, is the division we saw around investor reactions and details that we got from these company executives around AI. Of course, all of them talked about spending. That's a detail that you can't really hide from these days because all of these companies are just spending so much money on figuring out what its next steps are with AI. But you know, the investor reactions were a lot different. Meta got slammed because of a lack of clarity around AI and what AI could look like. Definitely a lack of proof points and business results. Microsoft, I thought, was a little funny. I don't think that they reported such a bad quarter, but I think, you know, some of the details were a little hard to process for investors against this backdrop of big spending. So the AI trade is dividing. I find that interesting, and I think that that's going to be an important theme to watch in the months to come.
And as lost in the sauce a little bit on Amazon is what Andy Jassy was saying on robots. I put that post out on X this morning. They're all in on robots. I think he noted they have 1 million various robots working in their operations right now.
That's what stuck out to me also in that earnings call that you noted. And I also noted that as well. Over 1 million in their fulfillment centers. And also, he said that they've got more inventions in flight and that there's going to be more of these. So this is where the future is headed for them. And the fact that he put that number out there that you think to yourself, wow, over 1 million robots already in their fulfillment centers, and they're even going to do more. I mean, this is going to be fully automated at some point. With Amazon, I thought that was striking. Of course, the AWS reacceleration also, but they're just their retail, their e-commerce, the AI tools that they're using for some of the product descriptions, they really fired out all cylinders.
And Inez, of course, that's AI is not the reason they laid off 14,000 workers. Of course, it's not.
Yeah, I know. It will always be very hard to tell, really, when these companies announce this. I mean, yes, he said he alluded to that. That's not there yet, but it's hard to tell. I mean, it's hard to be able to pinpoint that.
Brooke, one last thing that stood out to me from Amazon is the big push they're making into groceries, especially fresh groceries.
Yeah, Amazon essentially looking to compete with Walmart now. We know that Walmart's U.S. sales, about 60% of them are grocery. And what we've seen over the past few years, especially since that acquisition of Whole Foods back in 2017, it took a while for Amazon to really figure out how to integrate that business with the Amazon e-commerce business that already exists. And now certainly over the past few months, we've seen that doubling down, that day of perishable delivery on, everyday grocery goods. And that's a business that certainly I have my eye on as well, especially in this environment where consumers are really seeking out convenience when their dollars are a bit tight.
Amazon reports, Ron, that stock is ripping higher. Heading into this print, Ron, there were, questions, there were concerns in some quarters about AWS. I'm curious whether you think this report, Ron, does it put those concerns to bed?
It certainly helps. That's for sure, Josh. Thanks for having me. I mean, look, that was the debate going into the quarter, not retail, not necessarily health of the consumer, not profitability. It was AWS. How much are they losing share? Notwithstanding, are they gaining share? And what is their strategy in generative AI? And lo and behold, a few days later, we get more insights. And I think the most important thing from this quarter was the fact that Amazon now has the power in terms of infrastructure with 3.8 gigawatts being built over the last 12 months to support the demand they're seeing from an AI and core cloud perspective. So this was, I would say this was a quarter that wasn't even a down payment. It was, we've got the power. Now we can actually move forward and see continued demand. And there's a lot of different, what looks like shoots that we can follow that should drive continued growth going forward.
I also want to get your take on this North American retail business, up 11%,
Sure.
Ron. What are you telling clients, growth and margins could look like ahead?
Yeah, I mean, it's a great question because one of the highest margin businesses that Amazon breaks out is AWS, and for quite a time that's been the power generator of margins. But now with retail continuing to deliver double-digit growth, becoming more of an essentials to you and I, to everybody. So we like to call that wallet share gains, as it's so easy just to buy anything and have it delivered within the next hour or 2 days, whatever it is. That's becoming more profitable. And as that business becomes more profitable, I think Amazon could actually generate significant amounts of operating income and therefore cash flow, really to fuel their investments, of course, in capex and to make sure they have the power to supply all the demand. But frankly, to be a much more profitable company, and retail is at the tip of the spear there. We're starting to see more efficiencies. We're starting to see continued demand, and I think that continues.
I also like, Ron, you call that Rufus here. Now, that is Amazon's AI shopping assistant. You say a $10 billion plus incremental opportunity. Walk us through that, Ron.
Yeah, it's crazy. I mean, we have been talking about how consumers on the internet or consumer behavior on the internet is adopting and changing, right? So search engines are now more answer engines. How we utilize apps on the web today is going to be very different than how we do it in the future. Commerce is wrapped up in that conversation as well, and agentic commerce specifically, just because it is increasingly easier just to ask an agent, hey, look for the shoes that I've been looking for and alert me or buy it for me when it reaches a certain price. Rufus is able to do a lot of that for you today. And the better part of what Amazon is doing here with Rufus is they're leveraging all of their SKUs, their billion plus SKUs, their reviews, and what they know about us to deliver, or at least highlight to us, to surface to us some of the goods that we're looking for. And so the company yesterday talked about an incremental $10 billion from Rufus. Rufus just started not too long ago, but we're seeing greater engagement, increasing interaction, and frankly, conversion rates. And that's really the key for most commerce businesses, is driving that conversion rates. And I'd say Amazon is on the cusp of really starting off on the right foot with this agentic commerce strategy here.
Ron, I'm going to get you out of here on this. I know you're a believer in the stock, but what are the risks we need to think about over the next 12 months? What do you tell clients? Is it cloud competition? Is it macro risks? What are they?
Yeah, I mean, it's a bunch of everything, frankly. First and foremost, if we just look at the retail business itself, it's the health of the consumer. And so we really want to see a good, healthy holiday shopping event here coming up soon and have that continue going forward. And that's the retail side. Though I will say, offsetting that is just greater efficiencies in retail business, but the risk here is the consumer. competition. You do know there's Walmart involved and others in e-commerce, but frankly, it's an Amazon's ballpark. And then also from an AWS perspective, and we saw we're seeing the competition grow, right? A few years ago, it was AWS was the cloud provider. Now Azure's doing better. Certainly, Google's GCP is doing better, and frankly, AI is helping to leapfrog a lot of that. So we're not out of the woods yet with AWS, but goodness gracious, with the 3.8 gigawatts of power they turned on, and then 20+% growth, I think the future is certainly brighter today than it was a quarter ago.
I want to start with Amazon here. And when we talked to Doug Clinton of Deepwater the other day, he said that AWS growth needs to be at least 19%. And so they beat that bar.
Yeah, 20% is what we saw from AWS growth in the prior quarter. Obviously, I mean, that's why we're seeing the stock rip higher in pre-market. Even after the announcement, it just started shooting up right away. After, Amazon has been kind of the laggard of the kind of hyperscalers, Microsoft, Google, and Amazon itself, just starting to kind of turn the narrative around, I think, with this quarter. So they beat on the top and bottom line. AWS revenue 20% higher. They also announced that their Trainium 2 chip business, which basically is them renting out those chips to customers, is now a multi-billion-dollar business, and it jumped 150% quarter over quarter. So a big change there as far as the kind of overall sentiment seemingly for Amazon goes. That there's still some, hang-ups potentially. Again, Microsoft has OpenAI, Google has Gemini. Amazon has Anthropic, but they also work with Google. And so, during this week, they announced that they were going to use 1 million of Amazon's chips to, run their AI models. The week before, though, they announced the exact same thing with Google. So it's still that, I think, question of where's their big AI push, as far as a maybe potentially individual AI company or something along those lines. But the fact that they're getting this out of AWS is very meaningful. Andy Jassy saying that they're going to continue to build out just to meet basically demand as they go.
And I think what the final total tally on capex for this year, $400 billion from all the companies, which is just incredible. One of the companies that is not spending that much is Apple, because it's sort of taken a different path, Dan. But at least if you look at the stock today, that path seems to be working for the moment.
Yeah, I mean, it's interesting, the kind of way that Apple's framed next to some of the other tech companies. They're a consumer product company. They're not a cloud company. And so, yeah, the AI story is going to be very different for them. But they did fall short, very slightly short on iPhone sales in the prior quarter. And initially, that sent the stock lower. But then Tim Cook made comments saying, look, we expect double-digit iPhone growth in the current quarter. They're seeing very strong demand, they say, for the iPhone. In fact, they say that they're seeing issues just getting shipments out, that they're not able to keep up with demand for the 17. And so that's huge for Apple. There was that Counterpoint Research report saying that year over year growth 14% versus the iPhone 16 in the first 10 days that the phones were on the market in the US and China. So, we're seeing that kind of play out here now. And, I think when you look at Apple, you look at the fear that perhaps they weren't going to, return to big growth as far as the iPhone goes, the kind of double-digit growth. I think this kind of puts those fears to bed a bit. Services obviously outperformed. They're kind of just doing the right thing across the board when it comes to the iPhone, it seems. A lot of this has to do with the fact that people bought iPhones in 2020. It's 5 years later. They're going to upgrade. And the physical design changes that they made to the Pros and the Air, there's been some rumblings that the Air is not quite selling as well. But the base model of the 17 being such a good value, I think that's all just playing into this and feeding the sales. In addition, like I said, to that, the 2020 people bought a lot of phones. Now they're upgrading.
Give me that instant analysis and reaction. What do you make of it?
Yeah, so Josh, thanks for having me. I'd say, just on just looking at it initially here, I think you look at the top line was fine, bottom line was fine. I'd say definitely a little bit light in terms of iPhones, and definitely a miss as far as expectations in China. And, I'd say on the positive side of things, services did exceed our expectations. We were looking for about 13% growth, and it looks like it got a couple points above that. So, I think there were some good positives and negatives. I think really if I were to, pinpoint one thing that seemed like it was a pretty big miss, it was that China number.
And what do you listen? We're going to listen to the call, obviously, Angela. But what do you chalk that up to? But obviously, for an Apple investor, you make a beeline to China every time because it's that key link in the supply chain. It's a key end market. What are the puts and takes there? What do you want to know more about on that business? How it's performing?
Yeah, I mean, listen, I think the September quarter is always an odd quarter because you've only got a couple of weeks as far as the new phone is concerned, right? And it is more supply driven than it is demand driven. So I think the commentary for the December quarter is going to be a whole lot more important than what they actually posted here for the quarter. And who knows, how much inventory they kind of really had to deplete potentially in China, so looking at sell-in versus sell-through. So there's probably a lot of moving parts as far as the September quarter was concerned in China. But it is going to be important because we saw some very good growth actually come from China in the June quarter. The belief was it was going to sustain into the December quarter. So we do want to hear from Tim Cook. We want to hear that enthusiasm as far as China is concerned. The expectation, again, was that it was going to be the base model that would really kind of drive the China demand. And again, we want to hear that from Tim Cook. But outside of that, also, when you look at the iPhone numbers, in its whole, it did miss as well. So again, what does that momentum for the Pro devices here look like for the December quarter relative to the September quarter, and especially in the U.S. and these Western markets?
Yeah, you listen, Angela. You point out correctly, of course, that it's critical for Apple investors. They're going to listen to that call because you do want to hear that all-important holiday quarter. What do Apple execs have to say about the color and commentary they provide there? In terms of, listen, Another note that skeptics, of course, Angela, have been bringing up, including on this program, is the AI story. And the skeptical take that they'll say Apple doesn't have an AI story, doesn't have the compelling AI strategy that perhaps other rivals do. Listen, you cover Apple. You're bullish on Apple. What is your response to that?
Yeah, I mean, and if you're a bear, or if you're a bull, you're probably not going to hear much convincing as far as the AI story is on this call, because that's just not the way Apple works, right? I mean, you typically have to wait for a developers conference or some sort of rumors coming out, ahead of that event, really to get any gauge on what they're doing on the AI side of things. So you're not going to hear much as far as the AI story is concerned. What you do want to hear is the tone from Tim Cook. Make sure he's enthusiastic about that AI story and convinced that they are going to get that AI story right going into 2026 ahead of that developers conference, because really that's really all we can hang our hat on right now as far as this call is concerned. But that being said, I mean, we do expect them to get this story right. It's 2 years in the making at this point in time. They're either going to get it right, with whatever internal initiatives that they've done. But more importantly, we do think that they've got to have a backup of a plan at this point in time. And whether or not that's, Gemini with Alphabet or something else, we do think that we need to hear something, at least from the perspective of the tone of Tim Cook, that he remains enthusiastic and positive that we are going to see an AI rollout in 2026.
Yeah, I do see the compare there now, Angelo, on the tape for that Q4 iPhone revenue. $49.03 billion. Your colleagues on the street consensus, Angelo, was closer to $49.33 billion. So that did undershoot there. We're going to have to listen on the call in terms of the puts and takes the execs see now and ahead. What about the services revenue, Angelo? Listen, investors also pay attention to that. It's faster growing, higher margin. That looks like it did beat, as you point out. So 28.75 billion, analysts 28.18 billion. What are you modeling for that division looking ahead?
So we've been modeling, for the most part, about 12 to 13% consistent growth here, going into 2026. Again, we need to hear something along the lines of that from Tim Cook. It has been a bright spot here for the company for years now. And there was some concern earlier this year that maybe the services growth would not be able to sustain those levels, a lot because of the uncertainties, whether it be related to the Google search monopoly case or whether related to Epic Games and the outcome there. But that being said, for the most part, it seems like Apple has really kind of gotten the outcomes that they wanted at this point in time. And services growth should continue, we think, to at the very least grow at about a 12 to 13% pace here, we think, over the next couple of quarters.
Angelo, always appreciate that instant analysis, sir. Thank you.
Great. Thanks for having me, Josh.
Victoria, coming out of the block with you here. Do you like to see how much these big tech companies are spending?
Well, I think it's what's driving the market, as you were talking earlier. So I'm not sure that I like to see that there's a decline in the growth of free cash flow, because that's one of the elements that we look at specifically when we're looking at companies to invest in. Not that they still don't have a tremendous amount of free cash flow, they do. But we are seeing the growth of that decline as capex spend moves higher. And I think there's going to be a lot more scrutinization on these spends. They go higher and higher. We need to see the monetization of this. And when you look at something like Meta, where they said it's going to be notably larger, right? Well, what does notably larger mean? It makes me a little nervous when there's just kind of this open-ended element that we're just going to keep spending more and more and more, and we have to wait and see what the results of that are going to be. For now, however, the market seems to like it. It continues to push us forward, and we know that capex, as you and I have discussed before, has a really large multiple on the economy in regards to jobs, in regards to productivity, in regards to wages. So it is a positive for the economy as a whole. I think it's just the magnitude of it that we have to keep a close eye on.
Out of these three reports, Victoria, which one did you really, really like, and why?
Yeah, I think we have to say Google just knocked it out of the park. Alphabet just did great. It didn't matter what you were looking at, whether it was cloud revenue, whether it was search revenue, YouTube revenue, daily active users for Gemini. I mean, everything beat expectations, and beat expectations pretty significantly. So I think that was probably the strongest support or strongest report that we had. I do think that Microsoft maybe got a little bit of a bad rap here. I thought their report was actually pretty decent. Yes, they had the write-off because of the loss in OpenAI, but otherwise I thought it was a pretty good quarter. There was a little bit of a concern around Azure growth going forward, but I still think it probably didn't deserve to have the stock pull back. It might actually be a little bit of a buying opportunity for that stock if you don't have it right now.
Inez Ferre, let me get over to you here for some analysis. Look, I've never seen companies spend at these rates. To hear a Microsoft, Inez, come out here and say, we're going to double our data center infrastructure over the next several years is mind-blowing. I mean, none of us were alive when they were building the railroads in this country, but maybe this is what it was like. What did you like out of some of these reports, and what gave you pause?
Look, just as Victoria was noting, with Microsoft, Wall Street is basically saying that they would buy the dips here. I mean, some analysts are saying that perhaps it was a subset of investors hoping for even more growth. But look, make no mistake, they're thinking that this was a strong quarter. As far as Alphabet is concerned, investors are basically saying, look, Alphabet is showing a return on investment. It's showing, like Victoria was saying, in all its businesses growth. And so Alphabet is, that's why you're seeing the stock up today. And then with Meta, it's more of they're playing a long game and growth over margins in the near term. And that's why you're seeing Meta going lower. I mean, we have seen Meta go tank in the past, and then it has recovered. But it's really, Alphabet is the one that's the standout. And what I thought was very interesting about Alphabet was also their Waymo, which I know that you're not as hot on.
No, I'm not hot on any of this stuff, but I may not have no choice. I may have to take a Waymo at some point, Inez. I'm okay.
Yeah, they're losing. It's losing money, but they're expanding into London. I mean, they are. They're really firing on all cylinders.
Wait, didn't you tell me yesterday that you would put your daughter on there for karate lessons?
I did, and you know what? And you know what they talked about on the conference call? That they have a teen a teen service, and that's being used by parents. I'm telling you, moms do not want to be chauffeuring their kids around, and this is an excellent solution. That's what I was looking at. I mean, it's if you're talking about what stuck out to me in the conference call.
Well, look at Google listening and watching to Yahoo Finance's opening bid and getting tips for their earnings call. Brooke, I saw you here at the crack of dawn at your desk here in the Yahoo Finance newsroom in New York City, combing through a lot of these tech notes, and you really pointed out something good to me on Meta.
Yeah, we're hearing from just a slew of analysts. My inbox was filled with all these different earnings notes from analysts across the street. And Laura Martin over at Needham really pointed out this key point. We're seeing Meta really tank today. It's down now in the early innings nearly 12%. And what she pointed out was that Meta is explicitly prioritizing AI infrastructure over those near-term returns. And she went on to say effectively, they're asking shareholders here to underwrite open-ended R&D, development here, and compute build-out. And what's interesting to see here is we've constantly been talking about the forecast, the guidance, the expectations that these major build-outs and these build-up of these data centers really have investors trying to, lean into the hype and see that full picture. But yet we're seeing this pullback today, and Meta clearly saying, hang with us, this is going to happen. But then you see that increase in spending now projected now to be $72 billion. It's a pretty significant amount. And investors clearly a little bit maybe fearful here about this rollout, but also maybe taking back some of the returns, profiting from this lead up that Meta has had. Year to date, the stock is still up about 13%. And so with this pullback, it's really trying to keep investors and shareholders on board to really trust that this process will play out.
Victoria, I'm going through these earnings calls last night. I have a nice little bit of whiskey in the glass. I'm liking what Microsoft did. Sales were good, Meta good, Alphabet good. I mean, over 300 million, YouTube subscribers and Google One, crush it. And I came away thinking, Amazon's report is really going to suck.
Yeah, I'm a little nervous about the Amazon report. Everyone is going to be watching AWS because of the growth that we saw in cloud from the other names yesterday. AWS has to really knock it out of the park. I think expectations are for around 18% growth for AWS. I think they're going to need to get up in that 20 number in order for the stock to really have a positive movement there. So that's going to be the main thing that people are looking at. And I am concerned as to whether they're going to be able to meet those expectations. And then there's going to be a lot of probably discussion around, they've laid off hundreds of corporate workers, what that's going to look like. Are they being affected by tariffs on their e-commerce business? How much is that going to bring down profits? So I think there's a lot of elements there that could maybe drag on the stock after the report. So we'll be watching to see what happens.
And as last word to you over there, suddenly it's great to be Apple. Apple was pretty much trashed for the better part of this year. We have no AI. Nobody wants the new iPhones, yet this company is going to come up here, they're going to report and probably have good things to say about demand for the iPhone 17, and then the Apple trade is suddenly back.
Yes, and suddenly it's back to the basics and back to what Apple does best, and it's the iPhones, and they're also getting into this smart devices inside the home. And so, look, they haven't had this massive AI spend like some of the other companies have, and investors are really now starting to reward. Are you spending on AI effectively, or are you not, or is this a wait and see game? And that's what we're seeing with some of the earnings that have come out so far.
Q1 EPS. I see 372. I do not see a compare yet on that. But Q1 revenue, let's look at the top line, 77.67 billion. That looks like a beat. It looks like the street was closer to 75.55 billion. It looks like Q1 Azure other cloud revenue ex FX, I'm seeing plus 39%. Q1 Intelligent Cloud overall, 30.9 billion. The street was close to 30.18 billion. You would expect to see the guidance, of course, on the call from CFO Amy Hood. That's when you would get the color there. But we do see the stock initially here down about 4%.
Yeah, and I'm curious why maybe earnings coming in below those expectations. Again, we're waiting on that comp. But you mentioned the Intelligent Cloud revenue. That does include the Azure business coming in ahead of expectations. Of course, we did earlier today see a little bit of disruption when it comes to Azure, and it's a reminder of how tethered we are to the internet after that AWS outage not too long ago there. But shares are down roughly 4% at this point. And for a company like Microsoft heading into the print, the setup did look pretty positive. We've been speaking to analysts all week, and they have cited stronger enterprise tone, accelerating AI infrastructure demand from partners like OpenAI. Of course, we have that reset of that partnership with OpenAI. Microsoft holding a 27% stake in OpenAI's new for-profit public benefit corporation that's valued at roughly $135 billion. While OpenAI's nonprofit does retain that control, Microsoft does have the slight edge there in terms of the stake within this company here. So we'll continue to digest these results, parse through what could be driving shares lower, and of course the call is always important when it comes to those headlines.
Yeah, it'll be interesting there. At least initially here, it looks like Q1 Azure and other cloud services, XFX, plus 39%. I see that beating. The street looks like consensus 37.1%. Again, we'll wait for the call for more color from the CFO there.
And that's when they're going to provide forward-looking guidance on the earnings call too. So investors sort of wait and see mode to see what type of guidance could come in on the call. But yeah, I am curious to know what's driving shares, and we'll have to dig into this results in the report a little bit more. Shares down around 4%.
Great to see you as always. So let's talk about this Microsoft print. You know, the stock was up about 30% year to date heading into the print. We're slipping a bit here, at least initially. Importantly, of course, Rishi, we don't have guidance. We would expect under the call from CFO Amy Hood. I am interested in your take in the print and why you think we could be slipping a bit here. I do see spending on data centers being flagged, Rishi. It looks like first quarter capital expenditures, including leases, Rishi, $34.9 billion. That was up from $24 billion in the preceding quarter. But give me your take. What's your read on the report?
Yeah, absolutely. And Josh, always a pleasure to be with you. Really appreciate you having me. Look, I think this is just a very fickle market that we're in. As you correctly pointed out, Microsoft's had a good run year to date. It's had a good multi-year run since the AI narrative has started to kind of take foot. And this is everything we could have asked for from Microsoft this quarter, obviously guidance dependent, but 39% constant currency Azure growth, very broad-based beat and kind of every single metric, and continued cost discipline where you're seeing upside on gross margins, upside on operating margins. So there's really not much for me to poke holes in this, but just given the nature of the market and valuations here, it may be a situation of just, hey, the Azure constant currency number was 39% and some investors wanted 40%, right? And, candidly at scale like this, when we're talking about these sort of raw dollar figures, 39% constant currency is an outstanding number. So if the stock is down tomorrow morning, I would probably be a buyer of it, to be completely honest.
On that Azure cloud computing unit, as you noted, 39% revenue gain when adjusting for currency fluctuations. That beats what your colleagues on the street were looking for, Rishi. They were at 37%. I'm curious, what do you try to model out what growth looks like for that Azure business ahead? And what do we think the AI contribution is?
Yeah, look, the AI contribution, they stopped disclosing it, and I think they're having a little bit of trouble because, you're in a situation where everything's getting bundled together and, separating what's AI and what's not is getting harder and harder, right? And so they stopped giving that disclosure, but by my math, it's roughly, probably in the low to mid-teens as a percentage of the total Azure business, which is a really strong number, right? And bear in mind, they're using a very conservative definition of what is AI. They're not including any training of OpenAI models in there, which I do believe a lot of their peers on the in the software and technology sector probably do. And so I think this is a situation where a lot of the growth is being led by AI, but the non-AI piece is also benefiting from what we've termed this Azure AI halo effect, where because of their leadership in AI, we're seeing them actually gain non-AI workloads, whether that's happening through the OpenAI API or some of these up the stack products like Microsoft Fabric and Synapse and Cosmos DB. That's what I think is really going on. So as we think about modeling that going forward, number one, we think AI is going to be a bigger contributor because more of the workloads for Microsoft from OpenAI are shifting from training, which was never on the P&L, into inferencing and reasoning. Add in the fact that you have this new OpenAI deal, which we think is going to be an additional contributor to numbers, and you maybe even have some esoteric factors like Sora 2, which is obviously taken off like wildfire, and I think that's going to show up in the following quarters Azure numbers. So there's a lot that I think can boost continued super healthy Azure growth here.
Very quickly, Michelle, I only have a minute left, but on that Microsoft OpenAI relationship, we got the new details there. Microsoft's going to own about 27%, worth around $135 billion. Any more questions you have about that, Rishi, perhaps that could be brought up on the call? More insight you'd liked about that?
Yeah, look, I think it was a great deal for Microsoft and a great deal for OpenAI. I think both companies need each other. The one question I want to maybe better understand is there's a clause in there around Microsoft having rights to AGI, even post AGI, until 2032, and research rights until 2030 or AGI, whichever comes first. And what we don't know is who is on this council that's deciding what is AGI and what's not? What is the demarcating line? I think that's something that we'd all like to know a little bit more about, because obviously Microsoft, I think, does need OpenAI, and it would be great to see them still have all these rights, maybe even after post AGI. For now, I think that's something we just don't have a little bit too much clarity on, and I'm hopeful we'll get a little bit more today.
Rishi, always a pleasure to have you. Thank you, my friend.
Thank you.
Great as always to see you. Let's start off with Meta here, because I'm looking at the stock down about nearly 6.5% here, Aaron. What do you make of the report? What do you think explains the disappointment here, at least initially?
Yeah, it could be a combination of the tax hit, as you explained, kind of a one-time in our view, as well as I would say the expenses up a little bit, both on operating expense guidance for the remainder of the year, as well as the capex slightly increased as well. So that might be concerning for investors that may want to see some rationalization on the expense base. And so we'll have to look on the call for more disclosures there. But top line was strong. I would say they beat on the revenues for the quarter, ad revenues. The guidance for the quarter for Q4 also relatively strong, although largely in line with street expectations. But I would say revenue's good, maybe some noise around some of the expense issues as well as the tax hit.
They are seeing that full year capex, just to put a number on it, Aaron. It looks like they're calling out for between 70 to 72 billion. Is that roughly what you had penciled in?
Yeah, it wasn't far off. I believe last quarter it was 66 to 72, so a slight increase at the kind of the mid to high end of that range versus previously. I think investors want to hear on the call, though, in terms of kind of what this capex is going to be used for. They talked about potentially cutting some of the expenses around AI in terms of headcount. I think investors are still want to see what the ROI is on some of this capex spend. It's a little bit less clear for Meta versus an Amazon or a Google who's really spending that capex on cloud, given the strong demand those companies are seeing.
Some bulls come on, Aaron, and they said, listen, the capex spend makes sense to them because they say, well, we see where AI is having an impact in this name. We see it in the user engagement, we see it in the ad business. Do you see that?
Definitely for the core business, we do think it makes a lot of sense continuing to spend capex and AI for the core business. I think our point is on the non-core business, the super intelligence investments, less clear how they're going to monetize that at this point. It's obviously a multi-year plan as they talked about, but I think investors want to see a little bit more concrete data, concrete thoughts on exactly how they're going to monetize some of these non-core areas.
So that having been said, Aaron, about, listen, we got tax issues, expenses, capex. Having said that, you remain bullish on their name. You tell clients this one's a buy. What are the catalysts ahead that you see here?
Yeah, no, still expect continued strong revenue growth. Obviously, another quarter of 20% plus ad growth we saw in Q3. Q4 guide implies another 20% growth. We think it can grow mid-teens top line growth for advertising in 2026. And we think valuation is still undemanding. It does get a little bit more expensive if you look at it on a free cash flow basis, given that capex spend. So I think that's maybe where investors have a little bit of hesitancy. But on our GAAP earnings basis, we think we had them doing around $30 of GAAP earnings in 2026, so fairly reasonable valuation given their growth rates.
And so I guess you if you're bullish on the name, then Aaron, you agree with Zuck and you think, hey, listen, there's a huge opportunity here. We've got to invest to capture it, to capture that AI demand.
Yeah, definitely. I think it's the right move for now. At the same time, if they're not seeing a good ROI, or I think they need to have that option to pull back a little bit. And I don't think investors would be displeased if they decide not to spend another 40 billion next year incrementally on CapEx. So that's the question. I think investors just want a little bit more color. Are they getting a good ROI in that CapEx spend?
They are integrating that AI as well into the hardware, Aaron. So, it's the It's the glasses, right? Are you as enthusiastic about the hardware?
I would say I do like the glasses, the sunglasses initiatives with the kind of the Ray-Bans partnerships. I think less clear on the VR side. We don't think that's seen mass market adoption, and still less clear really if that will get mass market adoption long term. So do like the glasses investments, but less positive on the VR side.
So you're bullish, and you make the case, Aaron. When clients ask you, okay, with the stock down here about 6%, what are the risks I need to think about? What do you tell them?
Yeah, no, we still are bullish. We still, at the end of the day, as long as advertising growth is still growing kind of 15% plus range as we go into 2026, which we think it will be able to grow mid-teens plus. They still have a lot of option value in terms of these investments they're making. But if you look at the earnings power, especially if they pulled back on these investments, pretty significant earnings power that would drop down to free cash flow as well as GAAP earnings.
We are just getting Alphabet earnings right now, and it looks like another strong quarter here. We have Q3 revenue coming in above estimates, $102.35 billion. The estimate was just shy of $100 billion. CapEx spend also continues to ramp up, nearly $24 billion. The estimate was just over $22 billion. Operating income did miss expectations. YouTube ad revenue coming in slightly better than expected, and overall Google ad revenue also coming in significantly better than expected, 74.18 billion versus the expected 72.46 billion. Now on an EPS earnings basis, beating expectations there, $2.87. The expectation was for $2.26. Now, if that was the case, it would have been the slowest profit growth in over 2 years for Alphabet, partly reflecting that EU antitrust fine. But when it comes to this company, you are just seeing time and time again them outperform when you look at earnings. You're seeing that reaction in shares up about 4% in after hours trading. And it's an interesting company when we talk about AI. It's both a tailwind and it's also a threat here because Google's search business with OpenAI, that just emphasizes some of those competitive pressures. But at the same time, we do see that its Gemini AI models, Google Cloud's AI infrastructure deals with Meta, Anthropic, and even OpenAI have boosted optimism across the board. And when you look at the street targets, a lot of analysts out there are super bullish on this name, having price targets up as much as $300 a share. And we're inching closer to that number now, Josh, nearing 280 or 290 bucks a share as, you know, we continue to see the stock climb in after hours.
Yeah, what's impressive is this stock had a rally into this print. I mean, this was already up about 40% this year heading into the report. You're tacking on almost 6% in the after hours. Yes, it's about advertising and services. It drives the top line, but a lot of focus, as you rightfully pointed out, Ali, on that cloud business, and that did look like a beat. The revenue 15.16, the street was at 14.75. We have seen a number of AI deals involving Google Cloud, so in some sense you had a clue this was coming. Also, like its big cloud rivals, of course, Google is investing a lot in AI data centers. So I was looking at that capex number. It looks like they're seeing full year 91 to 93 billion. They had seen about 85 billion.
Yeah, that's a significant rise there. And I mentioned the competitive pressures with search. Search continuing to be resilient here. A beat, 56.57 billion. The estimate was for just under 55 billion. So search doing well, cloud doing well, increasing that capex spend, beat on both the top and bottom lines. Shares are up 6%.
I want your take on Alphabet as well. Now that's a different story. Alphabet, well in the green here. We are up 6% in the after hours. Impressive, Aaron, because this stock had already soared. It was up about 40% year to date heading into this print. Now you're tacking on another 6%. Give me your thoughts on this report.
Yeah, so it's really a combination of good advertising growth, as well as good growth for their cloud business. So I think Google for a while was perceived as a cloud loser or AI loser, and now they're being seen as a kind of a clear AI winner, both on their advertising business as well as for GCP. And I think GCP has been doing a nice job. Looks like they grew kind of mid 30% range for GCP, another very strong quarter there. And so that's starting to get a pretty healthy multiple as well. We think you can give Google Cloud Platform, kind of high single-digit revenue multiple on the business. And we were at a $310 price target for Google, but continuing to see good ad growth. We're not too worried about competition on the ad side at this point, continue to monitor that. But a combination of good ad growth plus good GCP growth, investors are willing to pay a higher multiple for Google today versus a few months ago. Plus the regulatory side looks to be off the table for the most part.
A big question around search, Aaron, right? Looking ahead, how much of a risk does OpenAI pose long-term, in your opinion, to that core search business?
Yeah, it is a risk. I mean, clearly close to 1 billion people are using kind of OpenAI or ChatGPT on a monthly basis. It's for a lot of younger users, they're using it pretty frequently. At the same time, Google has said over the last couple of quarters, users continue to use Google AI or Google and AI overviews, a driver of increased search activity as well. So at this point, we think ChatGPT has been more used for informational search versus commercial searches. If you think about commercial searches, whether it's e-commerce, travel searches, we think those are still largely being done at Google. I got to imagine ChatGPT, Perplexity, others have ambitions to get more aggressive on that side longer term. So something definitely to watch for. But at this point, we don't think Google's been losing share, or at least continue to grow search at a pretty healthy rate.
And I know you're a bull on the name, so even though it's enjoyed this strong run, Aaron, you must believe valuation still attractive on this one?
Yeah, no, so we had a 310 price target coming into it. It was trading around a mid-20s GAAP earnings multiple. Still think they can grow GAAP earnings kind of at a mid-teens growth rate, so kind of a 1.5 or so peg, which we think is pretty reasonable given their top line and bottom line growth here. And so, yeah, we think as you go out to 2027, a pretty reasonable multiple there as well.
Last question, Aaron. So you got Meta. You got Google. What is your hot take broadly on the digital ad market? How healthy, how strong does it look, and do you expect it to look? And are there read-throughs here, Aaron, to what we could hear from Amazon and its ad business?
Yeah, no, I think for the large platforms, Google, Meta, we think Amazon as a large platform will continue to see pretty good momentum. We've seen some of the smaller players on the advertising side not do as well, as they may be losing share. We do expect Reddit to have strong results tomorrow as well, and also Amazon on the advertising side. So do expect a good quarter for the larger platforms and advertising continuing to gain market share.
Aaron, always great to see and to have you on the show. Thank you.
Meta and Alphabet getting vastly different reactions from Wall Street to their reports. Meta right now down 11.5%, Google up 5%. Investors seem wary of Meta's increased spending, but Alphabet's being rewarded as its cloud growth shows strength. Joining me now on this, Brad Erickson, RBC Capital Markets equity analyst. It's good to see you, Brad. Thanks for being with us.
Of course. Nice to see you too, Julie.
In recent quarters, investors have looked at Meta's results and they've said, well, the AI is working. Ad sales are up, and they're using AI in their business. Why was that not the reaction this time?
Yeah, and maybe just to lay out like the simple formula of why these will work or not work, there's kind of like 3 things they have to do. Number one, they have to show how the core business is working and funding these investments. And if you have AI as a part of that, which both Google and Meta do, that's great. Right. But you need to keep beating expectations. The second one is you have to give investors a view and a vision for what these products and what these investments, frankly, can produce in the future that's not present today in the business. Google has given, I would say, a crisper or more substantive view, more likely view of success in that. And then the third one is obviously the spending levels and taking those up. And so with Meta last night, the key issue was the Q4 guidance came in a little bit soft, and it wasn't a lot. And honestly, they'll end up probably beating, we think, Q4. But the numbers are the numbers. And when you're raising spend that much and you're not giving people a vision that they really believe in on Meta AI or Vibes or any of these new things, it just makes it hard. That's why the stock's getting kind of killed this morning.
So let's take that vision part of it and dig into that a little bit, Brad. What is it about Meta that is not convincing investors in terms of that, like, this is what we're doing with this in the future?
Yeah, totally. And they talked about, when or if they see a paradigm shift. The way we frame it is that, Google adding AI overviews and AI mode and Gemini is really kind of a natural extension of search, right? Like we're all learning how to use this stuff. It's prompting new questions and new things we're asking for it. With Meta AI, I think you can make the argument that is a kind of totally new realm of utility, right? That people haven't looked to Facebook or Instagram to before. And so there's a bridge to cross there for Meta. And that's not to say the product's not going to be good, right? They have the super intelligence labs working on sort of making the model, they use the word novel, right? Which means differentiated from ChatGPT or what AI overviews or AI mode might look like on Google. But they're not there. And I think investors are sort of struggling to understand how they will get there because we just haven't seen the product. It's not in existence technically at this point. So that's kind of the issue.
And to your point, with Google, it's there. You Google stuff and it comes up, and it seems to be working. And they also saw, I mean, the Gemini app with 650 million monthly users. Was that also a surprise? And how important is that for Google to keep on growing that?
Yeah, the Gemini app certainly matters a lot, and that's kind of the direct comp to ChatGPT. So all good on that front. I think the incremental data point last night was the 75 million daily active users on AI mode, which they really only rolled out maybe like 5 or 6 months ago broadly to the US and Europe. That is super important because I think, for some of the early adopters and the hyper users of these, they will use, the ChatGPT app or the Gemini app, for example. But for kind of the broader masses, I would say AI mode is probably going to be one of the first introductions people have to generative AI. And the fact that that's starting to grow very, very quickly is a really good signal, I think, for Google.
What does that tell you about these concerns that people are going to just be going to ChatGPT, for example, and not Googling anymore? Is it still going to happen? Maybe it just pushes it further off?
I would say right now there's the fact pattern and the data points that have come out lately just do not support that view. That's not a knock on ChatGPT. Their growth continues. The adoption of that is still going really well. I think from a Google perspective, though, there's just clear evidence of incremental searches that people never would have done in a sort of traditional search environment. And if you continue to do those, there's going to be a portion of that mix that is very commercial. And Google is set up with 15 million plus advertisers to monetize that immediately. And that's what they said last night. It's already contributing to the growth of the search business. So there it is.
Brad, I want to ask you a bigger picture question on spending. Obviously, all of these guys are still increasing spend. They still expect to increase spend next year. Like, how far are we are we from a peak in capex on this, or you can't even see it?
Yeah, I don't even think that's the $1 trillion question at this point. That's like the $10 trillion question. Nobody knows, right? Like, I think, and last night sort of added to that uncertainty using Meta as the example, because like I said earlier, the revenue guide was not as good probably as people were hoping for Q4, which is necessary again for investors to continue underwriting these investments. And yet Mark took up the capex guide arguably in the order of $15 or $20 billion. So, well in excess of $100 billion a year now. So they're not even showing in that case, they're not even showing sort of a sensitivity to revenue being tied to capex, which means that it could go up, indefinitely. We don't have an answer there.
Fair enough.
Our next guest says it may be time for investors to look beyond the so-called safe haven of the Magnificent Seven. Plus, he also warns of circular investing taking shape across markets fueled by the AI boom. Let's welcome here Patrick Ryan, Madison Investments Chief Investment Strategist. Patrick, great to see you. So let's start there with big tech, Patrick. You had big names reporting yesterday. You got big names coming after the bell today. Big picture, what have you learned from those big tech earnings reports, Patrick? Do you feel like you have greater line of sight into that mega AI trade and trend?
Yeah, well, first, thanks for having me on, Josh. What we're learning is the earnings just keep on going. They're there. The earnings are there, but right now also the spending's also there. And I think that's what you got caught up in looking at, who did well today versus who did not do well today, broke down the spending, but the earnings are unequivocally there, but the spending numbers continue to be eye-popping. So I think that's where we have to be looking down the line and start to look towards, where is the revenue going to come from to make that work.
When you look at that AI trade, Patrick, as an investor, do you have concerns about what you're seeing there?
Of course you have concerns. I mean, there's parallels. Everyone wants to draw back to the late 90s and vendor financing and some of the circular nature of what we're seeing. So certainly when you start to see all these different companies investing in each other, you're wondering, are we getting near the end? Is this a way to keep propping up this continued AI trade? So, clearly OpenAI has got a big checkbook to keep writing all these different deals. And then you have NVIDIA coming in, giving these deals. But it starts to, as an investor, put your senses up a little bit more, give you that spidey sense, and an ode to Halloween here, that maybe this is getting a little bit long in the tooth.
So if it's getting long in the tooth, Patrick, and you're looking for other opportunities outside the Mag 7, where would those be?
Yeah, as long as the economy continues to do well, you can look down cap. So, I mean, when you look at a lot of the stocks have been left behind this year. I know everyone wants to point to the S&P versus the S&P 500 equal weight. That's been a big difference here year to date, where you look at, really the overall equal weight is about half of the S&P 500 right now. Only about 35% of the stocks in the index are beating the S&P 500. So there's a lot of places you can go. Certainly if you look at an economy that might be getting better, continued great GDP growth, you look at maybe some more capital spending along with one big beautiful bill and the immediate expensing, there is more opportunity down cap where the valuations are still, not necessarily screamingly attractive relative to history, but definitely attractive relative to the S&P 500. So if you get down into the S&P 600 or the S&P 400, much better opportunities, although the earnings right there need to pick up to make that happen, and you need the economy to start taking off a little bit more to see that come through.
I want to get your take on the consumer, Patrick, and where you think the consumer's at, how healthy, how resilient. I asked because, Chipotle reported results. The CEO made some comments there that were interesting, Patrick, and got a lot of attention, and basically talking about how the pullback in all income cohorts seen earlier this year has now widened, saying with low to middle income guests further reducing frequency. And I'm just wondering, as an investor, as you comb through those earnings reports, what's your takeaway of the consumer right now? How healthy does the consumer look?
Yeah, I mean, the Chipotle thing today is alarming because right now you've had that bifurcated economy where the high end has been doing well. The bottom end has not been doing well. The bottom end is struggling. And now you're seeing kind of that drip up into the next level. So clearly, if you look at the economy, consumer spending, that isn't alarming when you start to drift up into the next strata of consumers. Certainly, so you want to take that into account in your overall economic outlook along with what's the employment outlook. So if you start to see inflation has been hitting these consumers harder, it's starting to flow into the next strata of consumers. That's going to be a problem if we start to see the employment start to roll over into a kind of a more of a serious nature.
We talked about big tech, Patrick. We'd also like to get your thoughts on the Fed. That was, of course, another big event this week. And you got the cut, but of course, a lot of the focus was what on Jay Powell said about the next meeting, a December cut, no sure thing. I think he actually said far from it at one point, Patrick. What'd you make of that?
Yeah, I was surprised when he said it. Obviously, I think for most of the market, it was a foregone conclusion that December was going to be a cut. Even for the Fed themselves, they have that penciled in for another cut in December. So clearly there was a message he wanted to send to the market. I believe that maybe in the Fed's eyes, it could be a couple different things. The Fed may have thought that the market has gotten too far in front of itself, or in front of them in terms of their expectations for cuts. Next year, up until more recently, there was, odds of getting down under the 3% Fed funds rate. So clearly that had been spiraling down. And you also have a pretty wide, diverse opinion on where monetary policy needs to be at the Fed. So it could have been an ode to, the rest of the FOMC members to, to kind of hear their voice. So you had a dissent on each side. Clearly the FOMC wanted to send that message that, hey, it's not a foregone conclusion. We have a very, low visibility into the state of the economy, given the shutdown and all the economic data. So we just need to slow things down. But I think when you look at it, just at the repricing of December, the market's really not seeing that that it's not still a foregone conclusion. The market's still at, greater than 70% odds that we will see a cut in December. So definitely a message, but I think they end up cutting still this year. And next year, you probably won't see quite as much unless we see a deterioration, unemployment spike, or some other deterioration in the consumer.